Hello and welcome back to Golden Rule Radio, your weekly precious metals recap and outlook. And I know we said last week we wouldn't be doing a show this week, but with all the price action and volatility in the markets, we figured it was a must. And Eric, why don't you just give us a brief recap of what that looked like?
Well, it's been a wild week, if you will, Tori. Let's start just last Friday when we had, the metals take a plunge, followed, the Dow dropped heavily. The miners followed that. I think we saw gold drop about $70 below 1,600, below that level. Silver was, 4%, went from the 18s into the 16s. And then as we progressed, we had the weekend, more coronavirus issues, if you will. And then this week, it's been really wild. You had, the Fed come in with an emergency rate cut, dropping at 50 bips. That immediately took gold back above 1,600, pretty much to where we were last week. And with that, Miles, where are we at on the charts with gold?
Yeah, gold coming up just shy of 1,700. I mean, we're putting in some pretty high numbers comparatively to 10 years ago during the last gold run-up. We're well beyond that last shoulder, that last attempt that gold tried to push up back in like 2013. Now about $100 higher, or at least had been. And then, of course, with the market crash, and you've got to factor in futures options contracts, mining companies like you alluded to a second ago. Of course, that's going to bring gold down short-term with it, as well as the Dow fell 16.5% between the middle of February and this past week. However, gold has rebounded and is right back up into the mid-1600s. You have not seen quite the same pattern happen with the white metals, which we'll talk about here in a second, and I think that there's a very distinct reason for that, is because what we're seeing right now is panic buying, which may to some extent be attributed to the coronavirus, may also to some extent be contributed to the drop in the equities market, the drop in the transportations, which also comes back to the coronavirus and the shutdown of shipping lanes coming out of China. But gold popping right back up. It's popular not just overseas anymore. It's popular here in the States. In fact, I checked the COT report. The COT report from last week, February 25th, shows an 11-to-1 long to short ratio for the managed money category, which is pretty substantial. Managed money last week was expecting a big gold pop, and that's going to push the price up. It'll be interesting to see when this week's numbers come out, if that has trailed back down to as little as maybe 5 or 6 to 1, which would give you the impression that we might see gold start to sell off a little bit over the next couple weeks. But I think as we're looking at the chart here, because we haven't, again, continued to not see anything that resembles an actual pullback in the gold price. We've had these stair steps up, which includes some consolidation. We just finished likely another stair step up. You would assume there's either a reversal or consolidation. But the fact that when we took this massive $75, $80 drop Friday and Monday, and then have rebounded back up. This doesn't look like a turnaround. This looks like another consolidation for me. And how crazy would it be if in the next couple weeks we're testing all-time highs again? Because this just continues to get more and more parabolic on the gold price, just like palladium has done.
Yeah, we haven't broken to new highs, in terms of where we were 7 years ago. That April of 2013. Those previous highs are still intact. But
right.
Once we do, right, that's where you're expecting the parabola, if you will, to change its shape to a little bit steeper form. But, I keep hearing, ironically enough, you're pointing all this out, nice, healthy, bullish market in gold. And clients are asking me, why isn't gold doing what it's supposed to be doing in these markets? The stock market's crashing and gold's really not doing anything. And I want to counter that. Now, last week's show, we talked about the Monday and Tuesday huge, almost like a manipulation type of an effect of a dumping in the futures market. Friday was different. Eric started the show talking about Friday. Friday was different, and Bill King points out, he said, look, gold plunged like it usually does when equities tank. Okay, like last week's show we talked about, right. 2008. But that also happened not only fourth quarter of 08, but October of 87 and the first quarter of 2000. So he says, look, on liquidity crunch liquidations by hedge funds, investors, and foreign holders, as well as the regular month-end manipulation by gold shorts. So Friday was the end of the month. That's a really key point. So you do get some gold short manipulation in the market, but you get profit taking at the end of a month. And when margin calls come, you have to sell something. And some people have to sell almost everything, and that includes their gold. So yes, we saw a Friday dip. That does not change, to Miles's point, that does not change the fact that we're in a bull market and that gold's doing what it should. Look at this other chart here where it shows, look, if we look at what the equities have done versus what gold has done, along with the Swiss franc, you will see that there is still a concern and a flight to safety for any number of reasons.
Well, and on top of that, Tori, this wasn't something that was unexpected for us. I hear you telling clients all the time, as well as myself and Miles, that if the market does truly crash, you're going to see gold come down with it like we have in the past. This wasn't breaking news for us. It's
just a short little period, right? Exactly. I mean, everything gets sucked down initially together. You can look at it as one more last opportunity to step in if you want to lower your cost average. But there was a almost 17% tightening in the Dow Gold ratio. So we talk about ratios. Your portfolio was about 17% better off in the last 2 weeks by having a gold position than not having a gold position, because that tightening of that gold Dow ratio, or that Dow Gold ratio, is significant. That's showing that gold is acting like a hedge, just like it's supposed to.
So following on the heels of this end of February high in gold around 1690, let me go ahead and throw some Fibonacci levels on the charts, not because I'm calling for an immediate return to any of these prices. I'd like to see how price plays out over the next couple weeks, but just in case that was our high and we are looking at some type of retracement coming, here's some of the price levels I'd be looking at going forward for entry points for those of you that already have a strong gold position and are just looking to build on top of that.
Yeah, and I can speak for Robert. Talking to him today, he just said, look, gold always makes sense at any price over time. So don't get too sucked into the minutia of a particular technical breakdown in terms of an entry point. You may be asleep for it, right? It may be in the Asian market or the London market. Just take every opportunity you can to cost average in over time.
Sure, because remember when I said, hey, let's see if we get 1285? That's certainly, now it's 1485. So those numbers go up sometimes. And if you're sitting on no gold, you're not doing yourself any favors.
Well, let's hop over to silver, Miles. Silver, along with gold on Friday, I think went down, what did we say, in between 4 and 5%, bounced back a little bit, back above 17 now, but still has not caught back up to gold because our ratio is stretched out to 95-1.
Yeah, pretty crazy. Almost the highest we've ever seen it, and a fantastic opportunity for those of you that have been waiting to see, should I move a little bit of my gold into silver from a more growth-oriented, investment-oriented strategy standpoint?
No, absolutely, Miles. 95-1, Eric, we've been above 90-1 less than 1% of the time since 1970. So you talk about this potential energy building, we're there. And this is at 95-1 unmatched other than one other time in history, and that's like in 1991. So, and that was a very quick up-down spike, no time to trade. Talking to George here, who's been doing this for over 40 years. This is a gift, a nice trading opportunity to absolutely look at silver like it's gold at 50 cents on the dollar. So you're getting a 50% discount in gold by buying silver first right now, and then we can trade you in and pick up 50% more ounces.
And I think an important thing to remember, Tori, and we're close in proximity in the office, so I hear you saying these things all day, but you're telling clients you do not care what the spot price is when the ratio is 95-1, and you could not care less if it's 1750 or 1802. It's 95-1.
That's exactly right, and you're getting a double bonus. You talk about a 5% pullback on Friday that drove it to 95-1. We were below 17 an ounce and 95-1. So it was like a double bonus, and I couldn't scream loud enough to just buy silver Friday, but it's the situation remains unchanged now.
So looking at the silver chart here, I do want to point out one thing is that we may be building a channel in silver, and this is a big channel between 1650 and 1870, which was the big reversal. Now what we're looking at here, what a channel is we put in a new short-term high here through the end of 2019. We had a pullback, and we've had a couple attempts to push back up towards that high and have failed. So we keep putting in the same high and the same low, just shy of where the previous high was. I'll point these out on the charts. And we saw this happen back through 2017 and 2018. In the middle of 2016, we put in a new high. We built a channel. We finally had a breakout from the channel, came down, and then turned around, and now we're doing something similar again. So what you're looking there is you might end up seeing a fair bit of trading over a period of time. And the reason it matters is once you get into a channel, you tend to stay there for a while, because traders love channels because they know they can buy when it hits the bottom and then sell when it hits the top and pick off their 4% over and over and over again. Now, eventually somebody's left holding the bag, right? Eventually it breaks that channel one direction or the other. And usually it breaks up right when a whole bunch of people who are still trading that channel just put some sell orders in, or it breaks down right when some people put some buy orders in. So it can get dangerous when you get to the end of it. So I would love to see silver make a decision sooner than later. Continuations up tend to just continue. Down can tend to continue. It's when you end up stuck sideways for a while that you're sort of gambling. And this is one of the reasons why you'll hear, when you talk to your advisor at ICA, you'll hear us talk about the value of still holding a gold position within your overall metals portfolio, whether that ratio is 60 or 70 or 80 or 95 like it is today. I don't think there's anybody here calling for a 100% silver position.
That's right.
And it's important to remember that, because you're looking at pretty substantial volatility in these white metals. These metals are industrial metals first and alternative currencies second. And you always want to have the stability of some gold in your portfolio. Now, that may be 20%, that may be 80%, and that's where the ratios come in. But it's never zero, and that's why it makes sense to have an actual metals advisor who works alongside you with your assets, developing and building towards these strategies to help maximize some of this growth potential and protection.
So, Miles, I'm going to put you on the spot here because you were telling me a palladium to platinum swap story with your client, and I'm going to throw you under the bus here. Will you tell that story on the program?
I have a client who recently inherited a fair bit of palladium from a family member who passed away. And about a year and a half ago, he called me up to get out of that palladium. He saw how the ratio had moved. He picked it up and sent in about 30 ounces of palladium at that time to swap into platinum. He walked away with 30 ounces of platinum. So straight 1-to-1 swap at the time. Now, the way he looked at it is when that palladium was purchased, and the reason that palladium was picked up is because at that time he could have either bought 8 ounces of platinum or 30 ounces of palladium.
So he went from 8 ounces of platinum to 30 ounces of platinum.
Correct, by doing nothing, by adding no extra money.
By starting on the right side of the fence is really what he was doing.
Correct, and this is after we sent him a check to cover the capital gains tax. So if he didn't have the capital gains tax, it actually would have been a few more ounces than 30. Well, he just called me again earlier this week. He's got another 30 ounces of palladium from that lot. He held on to some, like we tend to recommend. Don't do everything at once. Watch how this stuff moves. Held on to some over the last year and a half. Well, he's sending me another 30 ounces of palladium that he's going to swap into 71 ounces of platinum.
So I'm gonna break this down for a second, because this actually just clicked for me too. Starting with 16 ounces of platinum
what
originally.
What would have been 16 ounces of platinum
now
instead
is
was
101.
60.
And now it'll be 101 between the two trades.
So, Miles, before we wrap up today, I know you're dying to talk about the Dow Transportation and how it fared this past week. So why don't you just get that off your chest real quick?
Yeah, because the Dow transports are obviously going to lead us right into the Dow Industrials, which I know everyone out there wants to hear about, because they're off 16.5%, but the transports were off 17.5%. And in fact, we pointed this out last week. There was, again, a channel discussion, but there was a floor that we had built in the Dow transports at around 9,700. And we had hit that number a couple times through 2019, and we broke through it last week, pushing below. We've actually come back up, retested it, and pushed back down. This is very bearish activity in the Dow transports. Now, we'll likely see a bit more of a fist fight. I don't see it continuing down aggressively, because you have to go back to that December 2018 low. Again, everyone remembers December 2018. If you don't, that was the month that the Dow Industrials fell almost 20% in a single month before they rebounded and kept pushing back up, thanks to fantastic buying done by the Federal Reserve Bank.
A major intervention. Liquidity.
Major intervention. So You're going to have some buying pressure at those prices anyway, but if you look on the chart here, that's where we saw that low over the last number of years, and that's what we came into this past week. There's no reason other than standing orders at that price or the magic wand of the Federal Reserve Bank that the Dow Transport should push back up, because as long as this coronavirus thing continues and as long as Apple can't ship iPods out of China, I don't expect to see the transportation average pushing up, and that's going to affect the industrials.
Well, Miles, we saw the emergency 50 bip rate cut yesterday, but the market still finished red. Today, big bounce back up. The Dow finished up about 4.5%, and the transportations, as you alluded to, up about 3.3%. So still lagging behind the Dow. But does that change what you just said? I know the market just closed as we're recording here.
No, because again, you know me, I care about levels, not percentages. I'm a price guy. I like where the prices are, because generally traders don't place transactions based on percentage moves. They're looking for price levels where there should be action taking place in the markets. And we're still below that price level. So as long as we stay down there, yeah, it doesn't really matter to me what the percentage return is. Now, if we push above that, then you start caring a little bit. But at this time, our recording time, no, I don't care.
I don't really expect a big rally. I mean, sometimes when you're in a bearish decline, and I know we haven't hit bearish territory yet, you have to hit 20% down. We're only in a correction right now, but you'll get dead cat bounces, they're called, right? Where you'll get this almost like a last gasp for air, and you'll come up a little bit only to erase all those gains and come back down. And when that's happening, to me, sure, it can speak of an attempt to give a little bit more liquidity into the market, but that's not the problem in terms of like just the coronavirus, for example. We've talked on this show for over a year that the markets were topping, and this could actually prove, for lack of a better term, I'm not trying to sound insensitive here, but it could be convenient if all of the blame could be put on the coronavirus scare, right? And both from an administration standpoint and an investor standpoint or anything else, the investor mindset or psyche, because we know the numbers even are being adjusted for third quarter of 2019 still. They're being adjusted down 50% from a GDP level. And so a lot of this has been this liquidity crunch starting with that December 2018 pullback or bearish pullback that you talked about. That's where we saw the massive liquidity crunch. And remember, in the fall of 2019 is when we saw all the repo madness kick in QE4. Why? For me, it's because all of this had already been foundationally laid.
Well, let me ask you one more thing, Tori, because another thing we've been talking about for over a year on the show is the push for negative interest rates. Is this the opportunity that the Fed has to go for those negative interest rates?
Oh, I think absolutely, but they're crazy. I mean, you've had negative interest rates in Europe for 7 years, and they have continued to have to pump liquidity into the system. It hasn't helped Japan or Europe in terms of their negative rates. So what does it signify when they're having to do all this sort of stuff? To me, it's still being proactive. It's not just stopping a stock market crash. It's trying to, again, avoid something far worse that's a global systemic issue that we're seeing in every country. So this is the first time we've done one of these shows where, we actually like to record on Wednesdays because it's the day of the FOMC meeting minutes being released and major Fed announcements. Well, this week it just happened to happen on a Tuesday, and call it unexpected, call it expected. A lot of people were calling for it Monday, and I think a lot of your technical realizations occurred because of the fundamental pricing in of this suddenly expected rate hike in a non-FOMC kind of emergency way.
Well, and look at the natural reaction of a market that's not allowed to act naturally. I mean, it takes a substantial amount of time to continue to push this money into the markets over a long period of time, but then the corrections are massive and very quick. I mean, we're talking about in 2 weeks giving up a year's worth of returns on the Dow Industrials.
Yeah, and when the real crisis hits, Eric, to get back to your question, they just shot an arrow, in my opinion, unnecessarily, right? One arrow less in the quiver. Because when that crisis hits now, what are they going to do? We're at between 1 and 1.25. If they do go negative interest rates and it's already proven not to work, central banks can do nothing but monetize assets when a real crisis appears. And that's why we love gold for the long term.
Well, that was a big arrow, right? They could have just shot the 25 basis point arrow, but they went with 50. So they started big there.
And another 50 expected from what we hear.
Well, and it's almost like you can go back in history and give Ben Bernanke a little bit of credit because at least he waited until after the market crash before dumping a ton of money in. But we're talking about the hottest equities market in history, and they're putting money in on top of that. It's this heroin addict addiction, not even waiting till you're coming down off the last high. You just need to immediately jump back into the next one.
Well, in short, we're going to wrap this up, but this is really all about taking your riches. Look, everybody's probably done quite well in the equities markets, and it's okay to take profits off the table. You move riches into a store of wealth. A store of wealth is something tangible, whether it's property, whether it's physical precious metals. Maybe you're storing silos of grain because you're a farmer, but move out of riches into wealth. That's what physical precious metals do. And just look at silver as discounted gold. It's all about the gold. It's the real money metal. And yet you can get there more quickly if you start with some white metals.
So that's going to do it for Golden Rule Radio this week. We appreciate you stopping by. If you liked what you heard, click the subscribe button, ring the bell, head on over to Twitter at ICA Gold, Facebook, McIlvaney Financial, or if you'd like to check out some more information off our website, McIlvaneyICA.com. And after doing that, give us a call to speak with one of our advisors about your personal portfolio. You can reach us at 1-800-525-9556. Thanks for listening.
Have a great week.